Do not make this mistake when it comes to capital gains tax. I'm telling you, I've heard this so many times. What people think about the capital gain tax is, problematic. All right, so remember, let's just dive into it. So my man, someone sent this to me. I forgot who it was, but much obliged to you who said, Alan, maybe? I forgot. But anyway, who did send this to me? Scott. Anyway, visual guide to understanding marginal tax rates. All right, visual guide to understanding marginal tax rates. So we're going to do two things. We're going to show you this on this engaging data, engaging-data.com. I'll put links in the show notes. And then we're going to go into Right Capital. All right, so you can see here, what we're going to do is we're going to say, let's just there's a lot going on here. Let's just do married filing jointly for simplicity. And we're going to say we got your gross income. Let's go here. 1 second. All right. Let me just set this up. So basically what they're saying is we're going to have, for simplicity, we're going to have $100,000 of gross income. $90,000 will be regular income, and $10,000 will be from capital gains. All right, so what we're going to do is we're going to take hover over $100,000, 72, 80, 85, 90, 95, 100. And what you'll see there is our average tax rate, i.e. effective tax rate, is 7.5%. Our regular income is $90,000. 24.4% of our income is not taxed because of standard deduction. We're married filing jointly. 19.4% of our income is taxed at 10%. 46.2% of our income is taxed at 12%. And our capital gains is 0 because we're still in the 12% tax bracket. And as long as you have long-term capital gains and you're in the 10 to 12% tax bracket or 0, you pay no capital gains on that. So here we are in the 10 to 12% tax bracket. And so you can see we're paying no capital gains. So our total taxes are $7,484. Our total gross income is $100,000. So we just say that's an average and effective tax rate of 7.5%. So a lot of people think I can make $1 million in capital gains tax and it won't be subject to income tax. Yes, it will. Yes, it will. Because they're saying, look, I have no income tax. I'm not in the 12% tax bracket if all my income is in capital gains. That's not true. Let's just make this go over here and say we got now 100% of our income is in capital gains. If we have $100,000 of married filing jointly, you can see we have $277 in taxes. Not a big deal. But what will happen is watch. So now we go to 135. Look at that. Look at that break right there. 120 to 125. You can see right 105, it's $277 of tax. 110, it's $1,000. So $5,000 in taxes of capital gains increased our taxes by $800. To 115, 1777. Look at that, 120 though. So basically, $15,000 of taxes increased our income. So we went from $105,000 of capital gains income. We basically had no taxes to $120,000 of capital gains income. We went from 0 taxes to $2,527. So the extra $20,000 of capital gains increased our taxes from basically nothing to $2,500. And the reason for that is because now you can see 20% of our income is not taxed because it's still in the standard deduction. 65.6% of our income is taxed at 0% because that's still in the 12% tax bracket. And then the next amount, or 10 to 12% tax bracket, and then 14% of our income is taxed at the 15% bracket because the capital gains, it does go into your 1040. And once you break the threshold above the 12% tax bracket, a portion of your capital gains will be subject to taxation. So many people think they can make $100 million of long-term capital gain or qualified dividend and not pay taxes. It's simply not true. So let's go to Right Capital. We'll just show you here. So we're going to go Right Capital Software, and we're going to bring a Bob and Jane sample again. And what we're going to do is we're going to say we have, we'll put $1 million. Yeah, here we go. So we make a taxable account. Let's just make that cost basis 0 so you can see what I'm talking about here. We go to 0 here, and we're going to say they have, I don't know, let's say 6,000 shares of VTI. Should give about $100 million. Yeah. So I got $1 million of VTI with no cost basis. And I'm just showing that to make a point about everything they sell will be subject to income capital gain. So let's say now, it makes sense what I'm talking about. All right. So we're going to say their goals are, Yeah, retirement, good, perfect. $100,000 a year. I like it. So there you go. And then let's make sure they have no Social Security. We're going to say none for the simplicity. And we'll say no Social Security right there. So that way we have to live off our portfolio. No Social Security right here. And we'll go down to no Social Security. All right, so they need $100,000 of income. They got $1 million with no cost basis in a taxable account, not an IRA. How's that going to work? So we're going to go to retirement, and don't worry about they'll run out of money, but don't worry about that. That's not what we're trying to show here. All right, so they ran out of money, but let's go to the cash flows, and you'll see they have. We're probably gonna need more. 100,000 still not quite out. Let's make Bob single. Hold on just a second. That's yeah, because they're still in the 24. They're still in the 12% tax bracket. They don't have quite enough. I tell you, we'll just go up here. Make it so they need income goals. They're gonna need let's say 15,000 a year in income. 15,000 a year, a month in income, just for simplicity. And we can do whatever we want here. But we go to retirement, and now they're going to be in the 22% tax bracket. So they're going to have a taxable gain here for sure. Go to cash flows, and you'll see they still got no taxes. Why are we not paying taxes? That doesn't make sense to me. Why is there no tax there? Expenses 100,000, net flows. Do I have you don't? Oh, I don't have any accounts. Okay. Do I not have an account? I thought I had an account. Hold on a second. Oh, I didn't save it, right? Oh, I didn't include in plan. There we go. All right, sweet. There we go. So we got inclusion plan. Helps if you include it there, big guy. All right, so let's go to retirement. And you will see they will have taxes here. If you don't include it in a plan, it won't be subject to planning. Stunning. So we go to cash flows, and you can see the taxes right there. So they have a $180,000 of expenses, but it's going to cost them $214,000 total. Why? Because they have some capital gain, and we can go to the 1040 to show you that. And we say, oh, look at that. So we got federal tax rate, state tax rate. What state do I have these guys in? Let's get rid of that state tax rate. Family. Let's just have them living here in, oh, they're still in Georgia. Let's just have them living in, let's say Texas. The state's different. I just want to go into the, in Texas, they have no state income tax, and they don't tax capital gains and dividends like New Hampshire and Tennessee. I think Tennessee is getting rid of that next year, but it doesn't matter. So go to Texas. There should be no income tax in Texas. Did I click on it? I thought I did. There we go. All right, let's see what we got here. This is winding up. It's winding up, Pablo. There we go. So no state tax, but we do have a federal tax. So let's go to 1040. Oh, interesting. So we got dividends of $20,000. Well, that is subject to tax, even though it's qualified. All of their dividends are qualified dividends, so that is subject to income tax. Again, the same rates as long-term capital gains are. If they're in a 0, 10 to 12% tax bracket, they pay no capital gain or long-term or a qualified dividend tax on that. But once they go in the 22% tax bracket, they do. And they got $217,000 of total income. Where do we get that income from? We go to 1040. I think it's Schedule D is capital gains. Yep. And you can scroll down here. They got total for long-term transactions right there. A gain. $196,000 of gains because they had no cost basis. Add that to their dividends and qualified dividends and long-term capital gains, $217,000 all told. Again, if we go to Schedule D, you'll see what I'm talking about. It'll say right there, long-term gain, long-term capital gain, generally held for more than a year, which they were. So let's go back here, and we'll see that because of that, they have $16,000 of taxes. Now, it is an income tax, but it's actually a long-term capital gain tax of 15%, above and beyond the amount that's taxed at 0, 10, and 12%. I hope that makes sense. You still have capital gains tax, even if that's your only income. And again, if we go to retirement, we'll just show you what it looks like. And here's another drawback too, and this is actually goes into with IRA accounts in particular. When you have to pay tax from your portfolio, well, here they have 15,000 expenses. Well, they got to pay tax on they got to pay tax on 15,000. So that's $180,000, 15,000 a month. They got to pay tax on that, so they got to distribute from their portfolio $196 to cover $180,000 income. Again, this kind of goes back to the whole thing with the mortgage. If you don't have that income need because you don't have a mortgage, you have your house paid off. You don't need to make the money in which to pay the mortgage. If you don't need to make the money in which to pay the mortgage, you don't have to pay taxes on that money you had to make in which to pay the mortgage. And same thing here. So if we go to zero, tax payment, $16,000, so they had to pull $196,000 out of the portfolio to cover $180,000 expense. Now, if we go to profile, all right, and let's just say we make this, let's say the cost basis is, I don't know, 800,000. All right, so now you can see they shouldn't have any taxes here. Let's take a look at retirement, because now they're basically getting return of principal, so there won't be enough capital gain in which to have them pay taxes. Now I don't care about this. We're just cruising through this. Yeah, no taxes, because now their capital gain is not enough to pay taxes on. I'll show you what I'm talking about here, because there's a return of principal for a good amount of their. So here you can see they still got dividends. They still have total income, so about $50,000 of capital gain, plus their dividends, plus the long-term capital gain. It keeps them in a 12% tax bracket, which means they have no taxable income. I'll show you what I'm talking about. So here we go to Schedule D, and they got $53,000 of long-term capital gain added to that $70,000 of qualified dividends. They got no income tax at all, because that still falls in the 12% tax bracket. Let's just say we made them go to, so let's give them some Social Security here real quick. I'm just curious. And we'll say they're making Social Security, already receiving. There we go. What will that do? Already receiving. There we go. Actually, let's not have her make any. We'll say she doesn't get any Social Security for old Jane. And off the top of my head, I'm not sure what this will do. It should make them pay a little bit of tax, I think, because that will be the provisional income, qualified dividends, long-term capital gains. But let's double check that. On top of their Social Security, yeah, a little bit of tax, not much. And then they run out of money right here anyway. So you can see the taxes on Social Security add to their capital gains, add to the qualified dividends, which gives them a tax burden, even though everything in of itself, long-term capital gains and qualified dividends and Social Security, are tax-free in individual increments, but you combine them together, they're not. Don't make that mistake on capital gains. Everybody does it, and it's not good. All right, we'll see you. Love to hear your thoughts. We'll see you.